Good afternoon, everybody. Really excited to see you and really excited for today. It's our first Fullerton Financial Live webinar of 2025. It's going to be an exciting year. We've got a lot of really exciting shows lined up for you, a lot of great content, a lot of great people that I feel fortunate enough to get to speak with and meet with. And today here we're joined by Cindy Montana. Many of you know Cindy or have worked with her already, but Cindy actually works with us here in the office, and she does all of our estate planning and our wills and trusts for a lot of our clients. And so we love her. She's incredible. And so we've got a great conversation ahead and a lot of really just cool information that I'm excited to get into. But before we get into that, I just want to make a couple of announcements. Just again, a lot of really exciting things to look forward to this year. As we got a pretty exciting season of a lot of events. We got a lot of really exciting events for you, for our clients, for our friends and family around here to just bring in and have a good time with each other. But we also got a lot of really good educational stuff coming up. So the first is on February 11th at 1 p.m. We've got our next Fullerton Financial Live. Put that in your calendar. That's February 11th. We're going to be talking about taxes. We're going to be talking about how to navigate some of the tax changes. Of course, we've got a new administration. Taxes is high on the list, I know, for Congress this year. And we've got the recent tax laws that were changed will be changing whether or not, well, they will be changing if Congress doesn't do something. So some of those will be happening. And with that, really excited. I know, or I'm hoping some of you guys have seen the announcement, but this year we are, for the first tax season ever, as Fullerton Financial offering tax prep services through our partner firm. This last year, we brought on board a CPA, Beth, and she and her team are already working with many of you on your taxes, and I'm really excited that's another service that we're going to be able to offer here at Fullerton Financial. So a lot more information to come on that. But again, February 11th at 1 o'clock on our next live event, put that in the calendar. Also on February 19th in our office in Peoria, from 10 to 11, we got a coffee talk. We'll be talking more about taxes there, understanding some of the tax changes that have happened, understanding some of the tax changes of how they impact you, how they could impact you this year, or some moves that you can begin to make to avoid some of those changes in the future. So again, really excited about some of these upcoming events, and man, we just got an action packed behind it. Well, Cindy, you need no introduction for many people who know or have been around Fullerton Financial, but your story, I'm just telling you, every time I get to sit down and meet with you and you and I get to talk, just even in my office, it's just, you have such an amazing story, such an amazing life, your heart for people, how you love people, obviously starting with your family, your husband, we were talking about that just a few months ago, but your family and then your community, and then, of course, the clients and how much you love on the clients. And it's just really profound and really incredible. It comes through in the way that you do your work. You've been doing legal work, paralegal work, and working on trusts and wills for how long now?
Over 35 years.
Over 35 years. How did you, I guess, for those who maybe don't know some of your background, kind of give a little bit of your background, a little bit of the story about how you got into this 30-something years ago and why you do it today.
Well, originally, my first job I traveled internationally and in third world countries. I worked on contracts to build medical centers and feeding centers for the impoverished. The people there gave me a really heart to want to serve people. So when I retired from that company after 20 years, I thought, what can I do? Continue to serve people in a way that makes a difference in their life and not just make a living.
Right.
I don't want to just make a living. I want my living to make a difference. And estate plan just kind of seemed to flow through me, because when you're counseling with people that are going through tough times, it seemed a lot of it had to do with death or estate planning, or how do they prevent their family from having to be enmeshed in legal fees and the court system. And so I just kind of gravitated that way because I felt like there was a need in it. I had a passion for it. And so 35 years ago, that's how I started.
And I mean, when we sit down and work through plans with you and whatever else, like you, just an incredible wealth of knowledge. What are some of the common things? Of course, you found this as an opportunity to be able to help people. When you're meeting with a couple or an individual or a family, what are some of the common things that you see that people either don't understand about estate plans, or maybe they think they know, but maybe isn't accurate, or, well, it's a pretty broad topic, pretty important, but it seems like there's a lot of misunderstanding of what it is.
And it is an important topic, but there are a lot of people that feel like, number one is maybe their estate doesn't have the value by which they would need an estate plan.
Estate plans are for rich people, and
Yeah.
we don't need that, yeah.
We don't need that. And for instance, Arizona, the probate threshold, that if you do not have a probate avoidance estate plan, the probate thresholds here in Arizona are if you have 100,000 equity in your home.
Wow.
And that's not a lot. If you're a homeowner, more than likely you have more than 100,000 equity.
Right,
Or not but or. Let's say you're a renter and you don't even own a home.
right,
If you have more than $75,000 in accumulated personal property, that will also send you to probate. And under the probate code, personal property includes cash in bank accounts. It does not include anything that has a beneficiary attached to it, like an annuity or a 401k or an IRA. But if you've got $75,000 in the bank and combined personal property, an RV,
a
cars,
CD, cars.
CD, money markets.
Yeah.
Stocks,
Mhm.
bonds, something that's
just
non-retirement,
in a brokerage account. not-
in a
yep.
brokerage account, then what will happen is if you don't have a probate avoidance plan and you pass away, your estate's going to go to probate.
Right,
Probate attorneys average about $550 an hour. And it takes time. It's a court intervention in your estate. And the goal is to make sure that when you pass away, that your estate will convey seamlessly and efficiently to your beneficiaries without court intervention. It's a time where the family can take the time to celebrate your life and not be enmeshed in the court system.
so if I get that right, you say, I mean, one of the things that people think about an estate plan or try is, well, again, I need to have a lot of money to have it. But you're saying, if you have either $100,000 in equity in a home, and that's if you've lived in Arizona for the last 4 years, 5 years, with how much, if you're trying to buy a house right now, you just know how expensive they are, or you have $75,000 worth of personal property. So that doesn't sound like you have to be very rich to be subject to probate. And for probate, that means, again, support intervention. Now, obviously, one of the things you want to avoid is having the court be involved in the state with some faceless state organization, but also for family. The contention around siblings, family members, like how often do you see that as being an important reason?
If there's not a clear estate plan, there's a couple of factors. Number one is, of course, you want to avoid court intervention, but don't you want an estate plan so that your family gets clear instruction? Because depending on your individual family dynamics, family may view what they should receive differently, or they may say this is what mom would have wanted or dad would have wanted. And so they're trying to discuss that out. Even if it's in a normal family conversation, they're trying to determine what would mom or dad wanted. But in a clear estate plan, that's set forth.
It's your wishes laid out.
That's right.
Now, what about what's it called? The executor of a will, or the person who's kind of carried out that? Like, what are some of the protections that you can typically find or that are built in? Because maybe some people will think, well, I'm not the executor on mom's estate, so it's kind of up to them. Is that accurate? Is it really up to the executor of how things go?
Well, it's up to the executor to follow the terms of the will.
Right.
It is not them to make decisions having to do with the conveyance of the assets. Those decisions should be clearly set forth in a good estate planning document. Now, in a will, there is a misconception that wills avoid probate. So people will say, well, I have a will, so I have an estate plan. And even though I own my home and it's paid for and I don't have a lot more, I have a will saying I'm gifting it to my children.
Right.
But it's still probatable.
Really?
Wills do not keep you from probate. Now, and there's different probate plans, probate avoidance plans for clients. It's not a one size fits all. There are some cases where a will might serve the client the best, but with a will, you have to make sure that all other assets are beneficiary driven.
Okay.
So let's say the only asset you own was a home.
Right.
and you had grown kids and not minor kids, and you wanted them to inherit the home.
Yeah,
You can have a will that
Right.
sets forth your wishes on where you want all of your personal property to go, and have like a beneficiary deed. Arizona honors beneficiary deeds. Not every state does.
Right.
Where they could put a beneficiary deed on their home, doesn't encumber their home, but it just states, when I pass away, if I still own this home, it goes directly to my children, inheritance tax free, and it
Wow.
avoids probate.
Wow, because it's basically like having a beneficiary on an IRA or a 401k or some sort of qualified. Now, you've really, again, talked about wills don't avoid probate, but a trust does. Is that correct? And what are the big distinctions between a will and probate? Because everyone talks about, well, having a will, my last will and testament, like a will is maybe the more common brand, if you will. But what's the big difference between a will and a trust?
If you have a will, and of course, that can serve your estate planning needs. If it's unique to you and your family dynamics, and like the illustration I gave, if you had a home and a will. What a will does is it gives the personal representative or the executor the direction on what to do with your assets. If you have a beneficiary deed on your home, that will has no jurisdiction over that home because it's beneficiary driven.
Right.
So a personal representative or an executive just follows the terms of the will. Now, what is the difference between a will and a trust? A trust is an entity that you create.
Okay.
It's an entity that's recognized by the probate courts in all 50 states as any asset owned by that entity avoids probate regardless of its value. You could be sitting on a home that's paid for and valued at $500,000 or $600,000 if it's owned by the trust.
Right.
Now, a lot of people think they lose access or control over their assets if they're placed in a trust.
Right.
They do not.
Okay.
With a revocable trust, they own the assets just under a different title.
Okay.
Let's say instead of owning them, the assets as husband and wife, they now own them as trustees
Got it.
of the trust.
Mhm.
Those are still assets. If they were going to apply for a loan and they needed to fill out a financial statement, all the assets held in the trust are under their control and belong to them.
Right.
A trust operates a lot like a will in the fact that the trust establishes who your successor trustees are.
Okay.
That's a fancy word for who's going to be your personal representatives under the estate. It sets forth your beneficiaries, the terms by which they inherit, such as an age, under what condition.
Sure.
And it also establishes the exact conveyance of personal property if you have specific designations.
Right.
So it operates just like a will, but it's to protect those assets that are owned by the entity from probate.
Right.
So someone may opt for a trust over a will because let's say they have young children.
Mhm.
And so the trust would reflect that those children, let's say illustratively, I don't want them to inherit until they're 30 years old.
Right.
I've raised 5 kids, so I put 30.
Have a little more responsibility under their
A little
belt. Yeah.
more
Sure.
responsibility.
Yep.
Science will tell you that the prefrontal cortex of the brain, that rational side of the
Sure.
brain, doesn't fully form till you're 25.
Oh, well, there you go.
So
That
you
makes a
don't
lot of
want
sense.
to
Yeah.
teach them inheriting.
Yep.
So the trust has some special provisions that you can put in there that the beneficiary doesn't inherit till they're 30. So the money remains in trust. And the uniqueness of a trust is you can set exceptions to that.
Okay.
If they want an education at an accredited university,
Sure.
the successor trustee, the personal representative, can go in there and pay for that.
Right.
But it also allows for other protections if you have special needs beneficiaries
Okay. Yep.
or underage beneficiaries. Or in some instances, maybe you have a beneficiary that you feel like you want them to inherit over time.
Mhm.
Let's
Maybe
say
that-
when they're 25, they get 10% and then
Sure.
over time. The
Maybe
trust is called a living trust, so
Sure.
it goes on until all the assets have been exhausted.
Uh-huh. So it sounds like there's a lot of different details and you can, so maybe there's some best practice language, there's just very more standard, but then there's really, you kind of make it whatever you want depending
It's
on your
unique to
situation.
you, absolutely.
So it's very important to sit down with someone and walk through what that is for you, for your family, for your circumstances. You said something I want to come back to, but I just also want to remind everyone, like the best part about this, and I know it's been a few months, we had a break over the holidays, getting into the new year, but I want to remind everyone, this is a live event. We are really excited about it because we get to have a two-way conversation with you. So one of the things that we're going to do here just a little bit is turn it over and start asking some questions or answering some questions that you might have. So make sure you go on, type in your questions. We can see them here on the screen and would love to get to your questions and answer anything that you might know. And of course, we got a lot of great events coming up, but we've got just an incredible wealth of knowledge here that we want to answer any questions on. So one of the things that you mentioned, Cindy, was being recognized in all 50 states.
Mhm.
The laws that govern your estate and what happens to you, are they federal laws or are they state level?
They're state level and they differ from state to state. So let's take the probate thresholds. Here in Arizona, I mentioned the 100,000 real property, 75,000 personal.
Yeah.
California has a different probate threshold. Texas would have a different one.
Right.
Some have probate thresholds as low as $20,000 combined.
Wow.
Real estate and personal property. So that is not state by state universal. What is universal state by state, that if your assets are owned by a trust, that trust is recognized in all 50 states. So if a trust was established in Arizona and you move to Texas, you do not need a new trust.
Okay.
Because you don't have to worry about if the trust thresholds to send you to, the probate thresholds are different.
Right.
Because you have a trust protecting those assets.
Sure. So I think that that's a really important thing to note, especially for us living in Arizona. Of course, we've had an incredible amount of population growth over the last, well, really over the last several decades, but even in these last few years. And I know that's something that we see pretty regularly is people who, who've moved here from another state, whether it be moving from California or from Michigan or Illinois or, many times from Canada, back east. The importance, and you've moved here and you've retired here, and maybe you've got a family or maybe kids followed you out, grandkids followed. The importance though of updating those legal documents, making sure that they are reflective of the state level, because it is state level law that impacts it. So what's some of the stuff that you've seen, I think, that where people maybe didn't do that? Do you have any examples of where maybe someone didn't do that and it was?
Well, if someone, and I review a lot of trusts from people who have moved here permanently.
Right.
And their trust was done in a different state, it's always good to have it reviewed. And so you review it, number one, even though if it's a well-done trust, it's valid here. They don't need, if they're told they need a new trust, they don't. But you want to review it to make sure that their wishes still comply. And that they made sure that by moving, that their assets are still held by the trust.
Right.
The number one issue in reviewing a couple that have moved out here with the trust is that they may have failed to put their new home in the trust. And so for that new home to be avoiding probate, it needs to be owned by the trust. So they'll have a home in another state that they sold out of the trust and then moved here. They need to be sure. So we make sure all their assets are funded in the trust.
And, again, you mentioned it, but again, it's just kind of the way that we do things is, you said, well, there's some people who come and say, well, you have to have a new trust.
Yeah.
Well, that's a great day for the person providing it because
Yeah.
they get to do the legal work and all that, but you don't, what I'm hearing you say is you don't have to get the new trust. You can keep the trust that you have. Just, it's important to get a second set of eyes on it,
Yes.
get it reviewed periodically, especially if you've moved recently or moved, since you last had it updated, to make sure that it still is accurately set up, not to get a new one, not to go through and pay a whole lot of expenses, but
Yes.
just to get it updated to make sure that you're safe.
That's right. And that's really important. I encourage anyone who moves here with a trust to get it reviewed.
Right. No, I think it's really important. And it's something that obviously we talk about. And I think when we sit down with clients or even, people for the first time, one of the most important things is that you need to get your trust or your estate plan documents reviewed. In fact, we feel so strong about it. And the fact that it's an important piece that actually here at Fullerton, when you become a new client, we offer for the first year, if you do it within the first year of becoming, and why is that important? Because don't wait. Why wait? So within the first year of becoming a client, we like to offer your services, included for free for those clients, to be able to make sure that their estate is properly set up. So, I think it's really, really important. One, obviously the conversation around a trust it's very important, but it almost always involves, and I'm going to speak from my standpoint as, a young family, we have young kids. You're talking about scenarios that are seemingly so far in the future. Okay, what happens when I die? Or what happens when XYZ happens in the future? This is something that's going to happen years down the road. Or you're talking about a scenario that is coming about because of something very tragic. What if my wife and I are on a trip and something bad happens, and now we have young kids that have to be raised by a guardian, by whatever. So again, it's typically some difficult conversations. How do you navigate those family dynamics and working with a couple to kind of understand and include maybe the next generation in some of those conversations? Like what's some of the best way that maybe there's a couple out there who's having a hard time agreeing on how to split it up? Well, our son, he struggles more, and so we want to help him out, but then that's not fair to someone else, or just some of those common issues. And see, how do you help walk people through that?
I want people to, first of all, it's really important. You're never too young once you're an adult to have an estate plan. Because my sense is it's called sleep insurance. These are unlikely events that may happen if you have young children, and like you gave that illustration, what if we pass away? You don't want the court determining who's going to be the guardian.
Right.
So we do an estate plan. You're not too young to make sure that all of your wishes are set forth, and then it's sleep insurance, and then you go live your life. But a lot of people have trouble navigating, number one, talking about death. Number two is talking about how do we divide the estate, because they have different, let's say, perspectives on one child needs more help and the other child doesn't, or this child has a good job and
Right.
this child is just struggling.
Right.
So should we give the one struggling more money?
Right.
So I help navigate that. It comes a little bit from a background I had in navigating some of the areas when I traveled internationally, and navigating kind of people coming to the table and sharing what their thoughts and ideas are,
Right.
and me through a Socratic method, asking them questions. And it usually ends up, they both want the same thing.
Right.
But what they have to do is they haven't talked about it before, because it's not common to talk about it.
Right. Yeah.
So now we have an opportunity. It's a little uncomfortable at first, but I first let them share what are their thoughts openly, and then through my Socratic questioning, we find out what it is they really want.
Right.
And then it ends up typically being the same thing. It's just they were verbalizing it differently.
Right. They just weren't maybe on the same page. And I mean, I think that's one of the most powerful components of what we get to do here, and across all of our different services that we offer. Is it's a lot of times it's conversation, and it's walking people.
That's right.
So where you're having conversations again here at Fullerton Financial. I love that Steve Seaton, you probably heard him say this. He says this all the time. One of our founders says that it's always about money. That's what we're in the business of. But it's always about so much. And so, often there's conversations that are maybe, they're not common. They're not typical dinner table like conversation of what happened with your estate or what happened with your finances, but they're important to have. Sometimes very helpful to have someone else in the room, someone else who can
Guide
kind
them
of
through that.
guide the conversation. Yeah. Don't forget, if you have any questions, please type those out. I know we've got a few coming in. We want to get to here in a second. One of the things that I think, is important is to just kind of touch on real quick. Is just what are some of the simple steps that maybe some of our clients or people who are watching today can do to get started in the process, to kind of relieve some of that stress, to get started in the process of making sure that they have, the kind of the sleep insurance, if you will, and that they've got the right steps in place, and they've got a right plan. So
I know sometimes you don't know what you don't know, and if I'm in someone else's wheelhouse,
Right,
and sometimes I don't even know what kind of questions to ask because I don't know what I don't know.
right.
And so I think the first step is to meet with an estate planner so that they can create an environment where you see what their options are,
Right.
what they have, what would happen if they don't have an estate plan, what would happen if they had this estate plan or the other. And it allows a formulation of a starting point. When you deal with this subject, some people don't even want that starting point. So if you have a good estate planner, they create the starting point and they share with their wheelhouse of knowledge with the individual so that they don't feel like they're talked down to, that they're
Right.
engaged in the conversation and now they have knowledge
Yeah.
about what they want to do and how they want to do it. You empower them with the knowledge.
Yeah. That's a great first step to take. Some of the questions, we've already been getting some questions. I'd like to turn to you guys. We've got it on a this is a pretty interesting question here from one of the attendees. Hi, Sydney. My dad recently passed away and left me valuable points. We have these in a safety deposit box. Do we need to update the trust on this?
If it's not addressed in the trust, yes, you should update the trust. As long as it's your trust and you were the originator of the trust, it's a revocable trust,
Okay.
you can amend it as many times as you want. So if a financial event or a family event changes from when you first established the trust, you should probably address that, yes.
Here's one. If I put all my assets in the trust name, how are they reported on tax returns? Meaning would I be facing corporate taxes because the trust is an entity?
Good question. The trust is definitely an entity. It was established for the purposes of avoiding probate. So the IRS's position on this is, I understand why you established this entity. So we're requesting that you do not file a separate tax return on this revocable trust. In fact, the taxpayer ID number for this trust is your social security number.
As an individual.
As an
Yeah.
individual.
Wow.
So if you get any bank statements that are named, let's say you have a money market account in the name of the trust.
Mhm.
When you get a 1099 on the interest in the end of the year, it may be made out to the name of your trust, but the taxpayer ID number will be your social.
Okay.
So that is placed on your individual income tax return and not a separate tax return.
So it's basically as an individual, treated as.
The administration is just as if you didn't have a trust.
Right,
Income tax wise.
right. Here's another great question. I've missed my first year to have a trust made. Oh, this is, actually, I didn't know about the option. And how much would it cost me to have a trust set up? So this is when you come in. This is a great question. So we actually offer these services. We'll make the pricing available and we'll circulate that afterwards in an email to everybody. But it's really a phenomenal offering that we have here. I mean, we typically try to make it, again, we know that it's really, really important. And one of our goals is making sure that, you know, all of our clients and people have a successful retirement. And part of that success is that their estate plan is set up correctly for those that they care for, or whether it be a family or an organization or, you know, whatever you choose to leave your estate to. So we'll circulate more information after this. But we do offer very, you know, discounted, I would say discounted rates.
Deeply discounted
and
rates. Yes.
Deeply discounted rates.
Deeply discounted rates.
And so it's something that I definitely highly encourage you to take advantage of, not only for yourself, but even for friends and family. Make sure that, you know, they're aware of it, because like I said, it is something that is important to us here. It's not something that we lean in on as a, hey, let's make money off of this. It's a service that we like to offer our clients and make sure that you guys get this important stuff put in place. So deeply discounted rates will circulate more information. Here's a good one. What are the costs of a probated will when it is current and well defined?
What was the question?
Yes, an interesting question here. We've got this. So what are the costs of a probated will? So a will, is that maybe they're asking, is there a will that can avoid probate, or a will that's been, as long as it's current?
The issues are, is the estate probatable? That's the number one question. Not every will an individual that has a will, that estate needs to be probated necessarily if they have beneficiary driven other assets. If you have assets that exceed the probate threshold and you only have a will, then that estate will go to probate. Like I said earlier, probate attorneys run around $5.50 an hour. There's that cost, then there's the cost of the court.
Right.
And then there's the time. It could take as much as 2 to 3 years to adjudicate that and make the decisions. The court has more control over those assets and where they go, though the will gives them some direction.
Right.
If you died intestate without the will and it goes to probate, the court has more liberal access to making decisions,
Right.
where with the will, it gives the court some direction, but it's still costly. There's no difference in the cost.
Right. When you've got a will and presumably a trust as well, I'll ask, so whether it's a will or a trust, how much do you define who gets what? Dad's tools, grandma's quilts, the cars, whatever other assets, trinkets, small things of value, pictures, paintings, family heirlooms. Are those the types of stuff that can be detailed out in a trust as well as a will?
Absolutely. When a good estate plan under a trust is established, the assets, all the personal property assets that you now own or ever own in the future without inventory will belong to the trust. So there are documents within the trust body that you can say, I want the grandfather clock to go to Uncle Joe.
Mm-hmm.
I want my wedding rings to go to my daughter Susie, with specificity. If there is personal property left that wasn't specifically designated,
Right.
then it goes to the remainder of your estate. Let's say you're leaving your estate to 2 children, 50% each, then the remaining personal property will be divided equally
At their choosing.
at their choosing.
But maybe you specified, hey, my baseball card collection that's very valuable
Yes.
goes to so-and-so
That's
or
right.
this, yeah. So you're able to spell out those.
Absolutely.
And this is an interesting one, and maybe it's a little more detailed, and so maybe we can get to, but a pour over clause. Are you familiar with kind of explaining what a pour over clause would be in a trust or?
There's what they're calling it is there's a pour over will. A lot of people say, I have a trust. The trust holds my assets, names my beneficiaries, and names who's going to administrate my estate. But what comes with this trust is a document that's a will that's called a pour over will. Now, that will is created for any asset that you left out of the trust with intentionality, but an asset that would never be subject to probate. You wouldn't leave your home out of the trust with
Right.
intentionality.
Right.
But let's say you chose to leave your vehicle out of the trust, because the trust code says anything that has a title to it must be titled in the name of the trust to be deemed owned by the trust.
Got it.
So a lot of people say, well, if I put my vehicle in the trust, I now have to call my insurance carrier because I've just changed title on who insures it.
Yeah.
And then I buy a new car next year and do it all over again. So some people will, with intentionality, leave the automobile out of the trust.
Got it.
So what happens when they die? The probate court says, don't come knocking on our door. We don't open probate for a vehicle.
Right.
But if they had their pour over will, the will dictates who gets the vehicle. The beneficiary of a pour over will is the trust.
Okay.
So without ever going to the DMV during your lifetime,
Right.
upon your death, that vehicle is conveyed directly into the trust. And if you want to leave it to someone individually or have it sold in the postage paid, you spill it out. That's a pour over will.
Yeah. Yeah. Really fascinating. Again, it's just a fascinating thing because you can do so much and you can specify as much as you want or as little. We'll do one more question. A lot of great stuff. And I think it's a really good one here because it's, it's unfortunately, it happened in my own family's life. My mom, she passed before my grandparents did, both of them. And it's something that we do see, sometimes is a very interesting one. What happens if your trust, your children are beneficiaries or the successor trustees, and the child passes before you?
With a trust, every well-written trust, most people, this is illustratively, will list their children as their beneficiaries. However, in the very unlikely event a child predeceases the parent, then what happens to that child's share? So let's say you had two children and you've divided your estate equally between them, but one child predeceases you. Well, we always do an alternate beneficiary and another alternate beneficiary. So in my trust, for instance, if one of my children predeceased me, my trust says it will go to any children they may have. A trust could say it may go to their brothers or sisters. There's no wrong answer here on an alternate.
Right.
It's whatever you choose, but what we do is we make sure there's alternates in the very unlikely event a beneficiary predeceases you.
Right. So again, important, there's a lot of details to work through, it's a big conversation, but it's something that's very, very important to get, put down. So I highly encourage you, if you guys have any additional questions, please send us an email. I know we weren't able to get to all the questions today, but again, we just love to be able to have the conversation and hopefully we were able to give you some great information. And Cindy, you're just such a wealth of knowledge that any conversation, we could go on for hours. We didn't even get to any of your stories of your time held in the jungles of some remote island. That's a true story. And I can't wait to share it with you guys. So if you want to know how Cindy, or if she survived off the island of Indonesia, well, she did because she's here with us, but how she did, book an appointment, come in and spend time chatting. So we'd love to get an opportunity to work with each of you. And again, if you feel confident that you've got a plan, or someone in your family or in your circle of friends or a group would love and benefit from this, we'd love an opportunity to meet with them as well. So again, just want to reinforce, we've got next Fullerton Live coming up is February 11th at 1 p.m. We'll be talking taxes. Again, this year, Fullerton Financial, get a hold of our office. We'll send you more information about it, but we're very excited to be offering tax prep and filing services through our new CPA firm that we have now in-house. And so would love to be able to share more information with you on that, get you connected with the right people, and make sure that, you've got a successful tax filing process this year. So again, February 11th at 1 p.m. we'll be doing our next Fullerton Live. Put it in your calendar. And then February 19th in the morning at 10 a.m. in our Peoria office, we'll be doing a live coffee talk. Again, talking about taxes and some of the changes that are out there that you can be aware of and be prepared for. So Cindy, thanks so much for taking the time and joining us. I know you've got a crazy packed schedule and it's a really, really busy schedule. So if you do want to see Cindy, please call in our office now. And make sure you get into a limited set of times that you're available. So thank you so much for joining us, and
Thank you so much.
appreciate it. We'll see you guys on the 11th.